McDonald's advertised a price it has no power to charge. That's not a figure of speech. It's the structure. About 95% of McDonald's restaurants are owned by independent local business owners. That's the company's own sentence in its own filing, published this month. So, when McDonald's built a national value menu this spring, 10 items under $3, it could only recommend the pricing. It couldn't set it. And this month, it told investors how many of its restaurants actually ran that pricing. 60 to 65%. That's the whole story. You weren't imagining the gap between the ad and the board. There is a number for it, and McDonald's published it. So here's the question this video answers. If McDonald's can't set the price on its own menu, who can? And what happens to a company that spends a quarter advertising a price it can't deliver? You remember when this worked. A McChicken was $1, a McDouble was under $1. The dollar menu was a real thing you could plan a week around, and nobody had to think about it. That was the Moat. Not the burgers, not the arches. It was price certainty at national scale. One ad, one price, 40,000 restaurants. You never had to check. A year ago, that machine was still running. US same-store sales grew 2.5% in the same quarter last year. The system was adding customers and revenue at the same time. This year, the same number came in at 0.8%. The engine didn't stop, it just stopped meaning what it used to mean. And the sentence underneath that number is where this gets strange. Here's the disclosure everyone skipped. On the US business, McDonald's wrote that comparable sales were driven by positive check growth, partly offset by negative comparable guest counts. Read that again, because it's the whole quarter in one line. Sales went up. The number of people going in went down. Growth and emptying restaurants are the same fact here. The company didn't put a percentage on the decline, it said the direction, and stopped. And the popular version of this story fills that silence with inflation. The inflation story is reasonable. It's also pointed at the wrong actor. Almost everyone believes McDonald's sets the price on a McDonald's menu board. It's one company, one sign, one price. That's the intuition, and it's wrong. A moat is whatever stops a competitor from copying you. For most of this company's history, the moat was scale, plus a price the whole country recognized. But scale here was built by selling the restaurants off. Look at where the money comes from. In the US last quarter, franchised revenue ran to about $1.9 billion. The restaurants McDonald's owns and runs itself brought in $784 million. Watch what that ratio does. 71% of McDonald's US restaurant revenue is a claim on what a franchisee rings up. It isn't a spread the company earns on food it sold itself. Worldwide, the same ratio is about 64%. So, this isn't a segment we picked to flatter the point. The US is just the sharper version of the same structure. And that ratio decides something the customer never sees. Margin is just how much of each dollar survives the trip to profit. And the shape of that trip is different when you collect rent instead of selling burgers. A franchisee who serves fewer people at a higher check pays McDonald's more, not less. The royalty scales with the receipt. It does not care how many receipts there are. Which is exactly what the quarter shows. Revenue up 4%. Earnings per share up 6%. In the same 3 months, the guest counts went negative. McDonald's had a good quarter. Revenue rose 4%, earnings per share rose 6%, and US same-store sales were positive. Nothing in this filing is a loss for McDonald's. That is the point. The structure means it does not have to be. And McDonald's says this out loud, in a document it filed with regulators. Its business model, it wrote, is designed to generate stable and predictable revenue, which is largely a function of franchisee sales. Franchisee sales, not franchisee traffic. That's not a slip, and it's not a confession. It's a design statement, and the design did exactly what it says on the tin. So, if corporate can't set the price, what did it actually do this spring? In late April, McDonald's launched the value construct. 10 items under $3, marketed nationally. But the construct wasn't a fixed meal deal. McDonald's own description of it, on its own call, was that it left operators room on individual item pricing. Corporate designed the architecture, the operator set the number. So the advertised price and the price on the board could drift apart across the country, and nobody lied anywhere in that chain. Corporate ran the ad it designed. The operator charged the number it chose. The customer walks in holding the ad and walks out holding the receipt. That gap has a name in the filings. It's called execution. Now that could just be a rollout still catching up. So let's test it. Here's the honest problem with everything I've said. Q2 was a hard quarter for people with less money, and McDonald's serves a lot of them. A guest count decline is exactly what a squeezed customer looks like, with no governance failure required. So the argument needs a control. Same economy, same 3 months, different ownership structure. Chipotle owns essentially all of its restaurants, 4,186 of them. It can change a price by decree. In the same quarter, its own filing reports transactions up 1%. One chain grew on both axes. The other grew on one. Same economy, opposite direction, and the difference between them is who owns the counter. And the comparison has a limit. Chipotle's customers aren't McDonald's customers. A smaller share of them come from lower income areas, which leaves one question. Is 60 to 65% a stumble, or is it a structure? Watch what McDonald's did next, because the fix tells you what management thinks broke. It didn't cut the price. It moved pricing execution into the franchisee business review process. That is a compliance regime. McDonald's also says the restaurants that did run the pricing performed better. That claim reportedly comes without a disclosed figure behind it. So we'll label it as management's own assertion and leave it there. A company that could cut the price would have cut the price. A company that can only ask has to build a process instead, which means the number everyone misread is the one that gives the whole thing away. And that reframes the 60 to 65% completely. Everyone read that number as an execution stumble. It isn't. Its existence is the proof. A company that sets the price on its own menu board doesn't have a recommended pricing architecture, and a recommendation can't have an execution rate. McDonald's published a compliance percentage for its own value menu, and a compliance percentage is something you only ever report about people you cannot instruct. Here's the line to carry out of this. A price a company can set does not have a compliance rate. That number everyone read as a stumble is the receipt. It shows McDonald's advertised a national price it had no authority to deliver, and McDonald's never said its franchisees refused. It said 60 to 65% were executing the recommended pricing. Some of that gap is a menu that launched 10 weeks before the quarter ended. And there is a second thing that happened this quarter, which McDonald's did to itself. McDonald's cut its own deal. It removed the buy one add one for $1 offer, its own national promotion, to pay for the new value menu. Its chief financial officer said so directly, and its chief executive called it a bad trade. Nobody made that decision but McDonald's. It is not a franchise problem. By the company's own account, it explains more of this quarter's shortfall than anything else here does. Those are two different levers with two different owners. One, the company controls completely, the other, it can only recommend. This video is about the second one. So, 1 quarter, 2 mistakes, and only one of them is structural. Follow the money out. So run the ledger. Fewer people came in, and the money still moved. Where did it go? The franchisor captured about $1.9 billion of US franchised revenue landed on McDonald's income statement last quarter. That line grew about 2%. The company's own restaurant sales shrank about 1% over the same 3 months. So the rent got bigger as the retail got smaller. That's the moat doing its job, precisely when the restaurants underneath it were doing worse. The shareholder captured. Revenue and earnings per share both rose in the quarter. The guest counts fell. The customer who stayed paid. Every point of that 0.8% came from check. The guest count line contributed nothing but subtraction, so the people still going absorbed all of the growth. And the customer who left got nothing. They were promised a national price at nearly 14,000 restaurants. About a third of the US system wasn't running it. They didn't get a worse deal. They got a deal that wasn't there. There's one more line in that ledger, and it landed the same week. The day before the print, the president of McDonald's USA gave notice. He'd run the US business for nearly 7 years. He stays on as an advisor into early next year. That's what an orderly handover looks like, not a firing. The structure is the story here, not the man. 3 disclosures, 1 day. The composition of the comp, the execution rate, and the exit. The forensic point is that all 3 are the same fact. So the value menu was real. The company advertising it just didn't own the counters that had to honor it, and it published the percentage that proves it. Here's what I want to know from you. When the ad and the menu board disagree, whose price was the real one? And there's a second half to this, because a compliance regime takes quarters to work. What happens on the next print is its own story.